private mortgage insurance is an essential concept for the National Real Estate Exam that every candidate must master to understand conventional loan structures. You must understand that private mortgage insurance, commonly known as PMI, is a risk management tool specifically designed for lenders. It comes into play for conventional loans where the borrower provides a down payment of less than 20%. From an exam perspective, the most important point to remember is that PMI protects the lender against loss in the event of a borrower default. It does not protect the borrower. Test questions will often try to trick you into thinking it acts like a life insurance policy or a standard homeowner policy that covers the borrower equity, but its sole purpose is to mitigate the lender risk when the loan-to-value ratio is higher than 80%. The loan-to-value ratio, or LTV, is the primary trigger for PMI. On the exam, you will likely see math problems where you need to determine if PMI is required. If the loan amount is more than 80% of the appraised value or purchase price, whichever is lower, PMI is going to be part of the equation. For example, if a buyer is purchasing a home for $400,000 and only brings $40,000 to the closing table, they are financing $360,000. That is a 90% LTV. Since 90 is greater than 80, that borrower is paying PMI. One of the most heavily tested areas regarding PMI is the Homeowners Protection Act. This federal law governs how and when PMI must be removed. There are two critical numbers you need to distinguish for the exam. The first is 20% equity or an 80% LTV. This is the point where a borrower has the legal right to request that the lender cancel the PMI. However, this request is not automatic and usually requires a clean payment history and often a new appraisal to prove the value has not dropped. The second number is 22% equity or a 78% LTV. This is the magical threshold where the Homeowners Protection Act mandates that the lender must automatically terminate the PMI. The lender has no choice at this point as long as the borrower is current on their payments. Exam writers love to swap these numbers, so remember that the borrower initiates the request at 80%, but the law forces the stop at 78%. Another area of confusion is the difference between PMI and MIP. On the national exam, keywords are your best friend. If you see the word conventional loan, the answer is almost always PMI. If the question mentions an FHA loan, the answer is MIP, which stands for Mortgage Insurance Premium. They serve a similar purpose but are distinct products for different loan types. A common trap is a question that asks about insurance for a government-backed loan and lists PMI as an option. Do not fall for it, because PMI is strictly for the private sector and conventional financing. A helpful mnemonic to keep this straight is 78 is the gate. This reminds you that at a 78% loan-to-value ratio, the gate opens and the PMI requirement must legally fall away. You can also remember that the P in PMI stands for private, just like the private banks that issue conventional loans. When you are sitting for the exam, look closely at the wording regarding who pays and who benefits. The borrower is always the one paying the premium, often as a monthly addition to their PITI payment, which stands for principal, interest, taxes, and insurance. Even though the borrower pays the bill, the lender is the sole beneficiary. If the borrower defaults and the house is sold at a foreclosure auction for less than what is owed, the PMI company compensates the lender for that top portion of the loan. Understanding this dynamic will help you navigate the trickiest finance questions on the national exam.